This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I know you're excited to get into today's show, but I have a very exciting announcement to share with you before moving to the show. We've just launched a complimentary and comprehensive webinar that, among other things, shows you how to legally use passive real estate investing to reduce your taxes, recession-proof your nest egg, and take the sting out of inflation. If you are curious to learn more, go to stevetucker.com/webinar. It is complimentary and only takes a couple of minutes of your time. Once again, that is stevetucker.com/webinar. I'll see you in the webinar. Enjoy today's show. Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Allen. Such a delight to be back with you again today. And we are going to take a look at Ron Rohde investing in commercial real estate. And Ron Rohde is a real estate investor, and he was a real estate investor before becoming an attorney. And currently, he combines his career and passion for helping real estate investors buy commercial real estate to build their wealth. He currently owns 3 properties in Dallas-Fort Worth area, totaling over 100,000 square feet, and he is always looking for new investment opportunities. So Ron, take us into the show and share a memorable experience that helped you to be the person you are today.
Yeah, thank you. Thank you, Dr. Allen. It's great to be here. Great chatting with you. Well, for me, I think there's one pivotal moment, it's related to real estate investing, but it was a accumulation of, several number of years of being a lawyer, just working for companies and firms, just as a young lawyer, saving up money and buying and accumulating about 6 single family rentals. And that's how I started, like most other people. But, I was just buying 1 or 2 properties a year. And eventually I had 6. And it was quite a bit to handle, even with property management. So at that time, I was newly married. We had kids. I was starting my law practice. And I made a conscious and thoughtful decision to sell everything, which was, DFW, Dallas, these are all in Dallas and Collin counties. Good price appreciation. I was getting 10% cash on cash the last couple of years. And I decided to sell and pivot into commercial, which I thought at the time fit more of my goals. And not only my goals at that time, but my goals in the future, which were my needs were to be able to deploy more equity in a single chunk, single check, longer lease terms. So I wasn't constantly figuring out how much rent I wanted to charge, constantly dealing with renewals or the threat of vacancy, as well as just getting rid of this day-to-day or month-to-month issues. Because I think what happens with scale at any point is you just get inundated with little questions. We got to replace the water heater in this unit. We got to replace the roof over here. We've got to do this. Oh, the tenant's asking for this. The property manager can execute, but they don't help you make decisions. And so this was probably a pivotal moment in my real estate journey, not just because it was the transition, but because of what it represented, risk and evaluating things and being what I would say is decisive, because I debated maybe selling half, maybe selling a couple and just going into one property and kind of straddling the boat. And I'm glad I didn't. And I think it was very formative in how I approach investing now, which is the endeavors where I've made the most money or learned the most. It's because I was early and I was decisive in terms of commitment. Mm-hmm. And so that's what I did. And I made that transition from residential to commercial about 6 years ago and have never looked back. And I think it was great. It absolutely fits my goals now, just as it did 6 years ago. But I was scared. There was some uncertainty there, but I made that decision. I didn't cut the baby in half, because that would not have, I think that would not have been a good outcome, to be in both worlds of residential and commercial at a time when I have limited free time to manage these things. So,
well, yeah, I can understand the trepidation and the fear in conjunction with that. While you're cutting down on work, you're also cutting down on tenants, and so one tenant leaves and you're left pretty vulnerable. So there's risks either way you go with it, and of course, charting a new path is always an anxiety-producing experience for all of us. Well, Ron, not only do you do your own investing, but as an attorney, you work extensively with other real estate investors. So you have some insight into what makes one real estate investor a success while others are not, and what can investors do to ensure that they end up on the success side of the coin.
Yeah, I think that's one of the reasons you see a lot of real estate professionals making that transition from maybe being a service provider, a broker, a lender, or a lawyer. And they make that transition to being an investor because we get to see so many deals. We get to work with a wide range of investors across all asset types. And for me, I got to see them full cycle. So I help somebody buy a building, they do their value add, they raise the rents, whatever, couple years, stabilize, and then they go and sell it. And you see that settlement statement, they make really good money just on a cap rate. And so, and net income increases. The people that I've seen that are the most successful really, really focus. And that means saying no to other things. That's me saying no to good opportunities to solely focus on the great ones and maintaining that focus in terms of, your day to day. What tasks am I doing within my world? Is it the highest and best use of my time? And that's why I've seen the most successful. You get everything that you want when you focus on it and you're willing to do that at the expense of other things. Again, it doesn't have to be all about money or financial efficiency, right? It doesn't say that, oh, I can't mow the lawn if you enjoy doing that. But it means that you only do two things: your highest and best use or things that you enjoy. And I think that produces a life that's very pleasant and enjoyable for those investors, but they have that ability to focus and they don't get bogged down in other opportunities that maybe look like a good deal. And they say, Ron, you're investing in industrial, you've got capital, you've got investors, you've got some ability. Do you want to buy this self-storage? And I'll agree, I'll admit sometimes I am tempted because it looks like a good deal on paper, but I am not a self-storage expert. I don't own any of that asset class. I don't know that particular nuanced. It may look like a good deal on paper, but I don't know it for sure that it's a great deal. And your time and your attention is so limited, especially in on a weekly or a monthly basis. What you choose to focus your time and attention on is all you have. And once it's gone, once you've diverted your attention, you can't get that time back to focus on something else that actually improves your operations of what you do. And again, I'm not trying to dictate every hour or every 30 minutes of people's lives, micromanaging, but there is a powerful concept of I do X, and it creates this flywheel. It creates the efficiencies. It gives you confidence. It lets you really expand above just being an average investor with good fundamentals and a little bit of capital and a little bit of confidence. That's most people. And I think you can get successful and you'll be happy if you do that disciplined. But the really successful investors focus on only the great things and only the things, and they spend their attention on things that only make their great things better to the expense of everything else. And they'll know nothing about multifamily cap rates. And they'll say, honestly, I have no idea what a multifamily trades for in this market. I don't know, 6, 8. They'll say, I only buy self-storage and we're at, 6s and 5.2. And this market will be a 5.0 or something historical. And that's powerful. I don't think you come across people that are so focused on their asset that they can tell you every single operator in their market, how much they paid, when they bought it, how many units it is. And it's impressive when you come across somebody like that who says, in this 20 square miles, I know every single asset.
That is very powerful. And I like the way you succinctly put it together there, because there are so many opportunities out there that can distract us, and that distraction really does dilute our best efforts. I was listening to a podcast yesterday, and the individual, I think that if I remember right, they were quoting Brian Tracy, and he said that the podcaster was saying he always said that you need to stay in an opportunity 3 years to really learn it and to be really good at it. And Brian Tracy said, no, you need to be in it for 7 years. The first 3 years, you're learning And then the last 4, you can actually take advantage of what you have learned the first 3 years. And I wish somebody had told me this many, many years ago, because I have diluted so many different things in my life with just going from one interest to another. And, we always think of the Renaissance people and how diversified they were. But when we actually look at the Leonardo da Vinci's and the Michelangelos and so on and so forth, they were extraordinarily, extraordinarily focused. So yeah, excellent, excellent advice there. Well, what led you, Ron, to actually focus your law business on commercial real estate instead of spreading yourself thin on that area?
Well, it's all I know. I think that I'm somebody who loves commercial real estate. I do it for my day job. I do it with my clients. And then at night, I work on my own investments. I review our leases and tenants and industrial buildings. And I can still go and talk to my wife about it some more. And she's like, okay, enough. I'll draw the line. No more talking about commercial real estate. And to me, it's just something that I love. It's something that I saw very experienced. That's my nice word for older people in their 70s, in their 80s, and they're still doing deals. And I said, that's something that I want to be a part of, because it's really a perpetual part of your identity, or something that you can make money. It's fun. It keeps your mind sharp. But I really like that it's something you can do at any degree all the way up, until you're 80. I mean, we had a client that the seller was 93, and he was managing some of these properties. Granted, he's not driving out there. He's not meeting with people, but he was looking at financial statements. He was reviewing issues that his property managers couldn't handle, and he had his son helping him, but ultimately it was still his property. He was 93, still, I thought, sharp as a tack. I said, that's the guy I want to be, because it's really something that you can stick with in a limited or reduced capacity, however involved as you want to be. But that's why I like real estate. It's just exciting and creative and much more positive than being a lawyer. So law is depressing, but real estate's fun. So I get to end up somewhere in the middle.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. So, Ron, what are some of the biggest legal challenges that real estate investors face, particularly around debt and financing?
Absolutely. I think it's on the tips of everybody's tongues these days. And historically, these interest rates are not unprecedented. So we can buy debt, and people can price and make money with these debt costs and this interest rate. The problem is how quickly the interest rates have changed. It hasn't allowed time for sellers to adjust their expectations. And there's still just that big disconnect. They call it the bid-ask spread. But the reality is that rapid increase in the cost of capital and investors still wanting to get a good return or a yield on their equity, there is a lot more opportunity to creatively structure the deal so that both parties win. And there's a couple different ways, but one is seller financing. And for people that aren't familiar, it's basically if you own a property free and clear, you're able to become the bank, or you hold back a note for any negotiated interest rate, the amortization, the LTV, all of that is negotiable. And the seller is willing to convert basically their equity into a debt portion of the purchase price. So we're seeing that as really popular, because previously when interest rates were in the 2, 3, 4% range, sellers weren't interested in getting 3% on their paper. That they call it taking paper back. I give you the deed and I just take a promissory note that's written on paper. But now with interest rates in 6, 7.5 or 8%, the seller financing is a lot more attractive, because I would take paper back at 6%, for example. It's a decent amount of income every year. There's interest income, and it creates a little bit more liquidity between the buyers and sellers. So if I'm offering 3.5, 3.7, you're asking 4 million. Maybe we say, okay, you would do 3.9 million, but with a large portion seller financed at a lower interest rate than the bank. And again, there's a win-win for both sides. The buyer gets a lower cost of capital because his source is the seller, and the seller realizes his maximum sale price, which is paper. So seller financing is a good solution for that. We're seeing escrows, so escrow holdbacks. Again, I'll pay you $4 million, your full purchase price, but it's contingent on XYZ tenant renewing within 6 months, which, maybe their lease is up and we just can't quite get negotiations. We'll say, you will escrow $500,000 of the purchase price, because if this tenant renews their lease subject to all of these terms, then we will release the $500,000 to the seller and you realize your max value. The buyer says, but if that tenant doesn't re-sign their lease under those conditions, then we get to get a refund of our $500,000 and we only pay $3.5 million for the purchase price. Because what typically happens, of course, is the seller says, oh yeah, that guy's definitely going to renew. He loves it. He's going to renew. He's going to renew. And the buyer says, well, why don't you just get him to renew before we close? And the seller says, I can't do that. They're a national tenant. They take a long time. They take 2 or 3 months. I want to sell today. Do you want to sell? And normally there would just be no transaction. There's just no meeting of the minds and there's no deal. So escrow holdback is very popular. And again, lots of different contingencies or conditions can be met. Of course, generates more legal fees. So I'm happy for that. But the complexity of the purchase price being contingent on certain milestones occurring helps the market clear product. It helps meet them in the middle. And I think that creatively understanding the goals or the needs of your seller are the best way to get deals done in this market, even with the high cost of debt, because you've got to think outside the box. So,
and I think that goes back to what you were saying to start with, that focus is very important, because what kind of novice is going to think of these alternative ways and means of really bringing a transaction to completion there? Good ideas there. Well, what are some of the most common mistakes that you see real estate investors make, and how can they avoid them?
I think the most common mistake, I would say, is not quite understanding what you're going to do if your tenant leaves. And what I mean by that is there's kind of this discussion going around, and I won't say it's among professionals, but what are you buying when you buy commercial real estate? Are you buying the dirt? Are you buying the building? Are you buying the tenant? Are you buying the lease? And all of those answers are all true to some degree, but there's a real emphasis on the lease and that cash flow associated with that lease, and people underwriting that, and whether it's a discounted cash flow DCF model, that's all good. But at the end of the day, that tenant could go dark tomorrow, the day after you purchase, and then you're left with the building. And what's the condition of the building? What's the market rent? What's the demand for that type of space? How would you relet it? How would you price it? How would you decide how much tenant improvement allowance to provide that tenant? These are huge questions that, say, on an office building or retail or even industrial to some degree, they're open. And I don't know what the right number is. $5 a foot, $15 a foot, or $45 a foot. The tenants will ask for the moon, and it's your job to push back. And so I think that's the biggest mistake, is getting too locked in on one valuation prospect and not really thinking about, how do I re-tenant this? What do I do after 15 years and the tenant just, naturally gets to the end of their lease? You're going to have to find a new tenant. And what's the shape of the building? What kind of improvements? Is it future-proofed for the future demands 15 years from now of future tenants? Because if you don't stay on top of those types of issues, the value of your rents is going to go down and the value of your building will go down. And that's a huge issue, is future-proofing and understanding the needs of the next 10, 15, 20 years. They're very different than today. And if you're already buying a building, quote, behind the curve, it's only going to be exacerbated when you try to go to market in 10 years. And you may not have any takers, right? There's a distribution, but if you fall too low in terms of the building's functionality or capabilities, there's nobody that wants to rent it, even if you're giving it away. They don't want to put their business there. And that's difficult. And I think people don't think about it at all. They just say, I'm going to buy it, I'm going to cash flow it, I'm going to do a little bit improvement, and then I'm going to sell it. I'm like, okay, but what happens if you don't sell it? And there's some strong arguments to be made not selling buildings if you're just going to redeploy that capital to generate more return. It's I don't know, it's probably another topic for another video, but your investment thesis of what's your hold period is critical. And there's a lot of people saying the amount of effort to find, underwrite, and close and transition a property, it is not exceeded by the returns of getting more money and buying another property. It's a lot of risk every time versus a forever hold and just saying, why don't you just focus on collecting the dividends, increase your value where you can, and if you can increase the value of the building, just refinance. You can refinance all your equity out. It's commercial, so it's a lot easier to do that type of refinance than on the SFR residential world. Those lenders will want to keep some equity in and they won't value it as high. But it's a really interesting question about how much is too much. What's the optimum velocity of your equity? Because I don't know. I like the math on both sides. There's people that say you should sell every 3 years if you're actively working in the business and raising rent. But with transaction costs, to me, it's not so clear that you should sell. So
yeah, I'm kind of on the buy and hold side of that. And like you say, you can take your equity out through refinancing. Not only is there the risk in going through a new transaction, like you just mentioned, it is very, very time consuming. And why not keep your properties and take advantage of the appreciation through the refinance? You don't want properties out there free and clear in the first place. So why not just refinance them and keep them covered in debt to reduce your chances of being sued? So,
yeah, debt is a great asset protection tool as well. I think people don't talk about it enough, but if there's an incident, recovery is limited to the equity, and putting some debt, and again, doesn't have to be 80% LTV, but just putting 50%, very low conservative debt, but it's a very effective asset protection tool. So
yeah, for sure. We have some more questions here to go, but tell us what you have to offer our viewers and listeners, and how can they take advantage of that?
Yeah, I'd love to help anybody who is looking at buying or leasing commercial property. So this is office, retail, industrial. Industrial is my specialty. That's probably near and dear to my heart because that's all I invest in the DFW market. So I don't consider myself an expert, but it's all I do. And I have the benefit of representing dozens or hundreds of transactions in this market as well. So I get to see a lot more than just what I transact, which is great. But no, I'm happy to help anybody with legal issues to kind of, if you don't have your go-to lawyer. I'm somebody that I work a lot with, say, second generation real estate, because the father, has assembled a great portfolio and he maybe has a forever hold, but his lawyer happens to also be his age because it's his colleague, his friend, his contemporary. And so I'm really excited to start building those relationships with my colleagues who are in their 40s, but at least we've got a runway, we've got another 20 or 30 years to work versus an attorney who's 60s or 70s. Because some of those guys are still practicing. Hats off to them. But yeah, that's who I would say is just, my ideal client, somebody who wants to invest in industrial real estate, but doesn't know too much about all the sub asset types, or, what are the gaps? What are the things I don't know? And you don't know what you don't know. That's really what it's like in commercial. I think it holds people back. I think that fear of the unknown, and there really aren't a lot of great resources. So I'll give a little plug for my YouTube channel. That's probably the best way to follow me. I post a ton of content on industrial real estate, leasing, PSAs, commentary on the market, but that's the best way to get a hold of me. And yeah, I think it's the future of how people learn is online and through, great content like podcasts. People listen everywhere.
Well, what is your YouTube channel?
Good question. Ronald Rohde Law. So RONALD ROHDE Law, LAW. So if you just search for that, my first and last name, that law firm channel pops up. Had a lot of success with it. Over 2,000 subscribers, and God knows a few 100,000 views. So,
well, excellent. Ron, let's just give some advice here to those who are new in the industry. How do they get started, and what steps should they take to ensure their success?
Absolutely. I love that question. I love talking to that person who is in that stage of their investment journey, because the number one thing you have to do is figure out your own goals. You need to figure out yourself. You need to take into all of your life experience, what you liked about investing, what you don't like about investing. Figure out how much capital you have. How much are you going to allocate? How much equity are you going to put? Are you going to do this by yourself? Could you have a partner? I highly recommend, partnering with somebody if you have somebody that is a good candidate and there's a high level of trust, because it makes things a lot easier. You have another person to talk to. Real estate tends to be kind of a lonely game, but having a partner is just alleviates a lot of that. But so know your own goals. Figure out, take a survey on the past of what you enjoyed and what you didn't like. Figure out how much capital you have. Figure out your timeline. We talked about the hold periods, but figure out what kind of return you're also targeting, because really return is dependent or drives off of risk or the amount of time required to produce that type of return. Because I don't want people to get suckered into, buy this car wash and get 12% cash on cash. Okay, well, a car wash is a business. It's incredibly competitive. There's one on every corner. You've got machines breaking down. You've got all this service. Who is going to be doing that? Because yes, to get a 12%, but you have to maintain that, versus put your money in a T-bill and get 4%, 4.5%. That's zero work, right? So that'll be our extremes for the examples. And there's a wide spectrum in the middle. And I can't answer that. There are no wrong answers, but you've got to think about what is the amount of work for the amount of return that you're willing to take. And then after you figure out what your own goals, what your timeline is, what your investment horizon, what type of assets, you like, you need to do a survey of what's out there. There's all your popular asset classes: multifamily, office, retail. Retail has really had a resurgence ever since COVID. There has not been new construction, but the tenants who are doing well and doing business that need to expand and add locations, it's a landlord's party in terms of fielding tenants. So retail is very strong right now. Industrial, I love industrial, but you need to do a survey. Do you like self-storage? I know you mentioned self-storage, and it's popular for a lot of reasons. It's a low cost, low absolute cost barrier to entry, but it's a business. There's got to be some marketing. You've got to have Google My Business. You need to have staffing to do clean outs. Yes, you can automate a lot of it. And yes, you can do a lot of, remote stuff. But at the end of the day, you need some boots on the ground on a pretty consistent basis, because you have security cameras. Something happens that you see and but who's going to take care of it? And if you can't, transport yourself, if you can't drive there quickly, you need to have somebody else that can go on site and fix the problem. So that's fine. And again, no wrong answers, but do a survey of all those asset types and figure out the size, figure out what the purchase price is. And then just, I think consume as much as you can about your target market, and that will drive off of your price point versus your returns, right? There's people in California. There's still money to be made investing in California. You just have to buy right, and you have to understand that the entry price is a bit steeper than a comparable multifamily in Dallas. Their cap rates are still the 2s and 3s in LA, and we're in the 5s in Dallas. So that said, that to me is the steps. And then the third step is probably just building your team. So start adding all your vendors, talk to your accountant, talk to lenders, talk to your lawyer, talk to your property manager, accounting, inspector, general contractor. There's all sorts of people that comprise or support you as a real estate investor, and you need all of them. Brokers, leasing brokers, listing brokers, investment sales, so many people that you should start to know. And that's step 3. And then step 4 is go buy a deal. Push some LOIs out, and underwriting. I probably could do a whole other video on underwriting. Once you find something, what's the right price to pay, and then push lots of LOIs out and make a deal
and do it. Well, Ron, it has been a pleasure having you with us today. Lots of wisdom and expertise you've shared with us. Thanks for being with us today.
Thank you, Dr. Allen. It's great chatting with you.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.